is there a real bull market in athletic apparel, not just something ephemeral? In the past few weeks, both Lululemon and Under Armour have rocketed higher. And I think it's worth pondering whether these two stocks might even have more to run after these moves. So tonight we're going off the charts with the help of Dan Fitzpatrick. Oh, he's a terrific technician. He's also the founder of Stock Market Mentor, as well as being my colleague at realmoney.com. Get a better read of this situation. Let's start with the daily chart of one of my absolute favorites, Lululemon, which has vaulted 70% from its lows last December. Now, is it too late? You got to ask this. Whoa, to buy Lulu? Well, you're late, but Fitzpatrick thinks you might not be too late. As he sees it, there's evidence that this stock is still being bought by big institutional investors, and that means it could have more upside. Near term, he thinks the stock could go to $200. Longer term, he thinks it's headed to $220. Nice. Ever since Lulu reported a truly blowout quarter at the end of March, the stock surged from 146 to 167 and really hasn't looked back since. Instead, we spent the last few months consolidating these gains, trading sideways between 160 and 180. Then yesterday, Lulu broke out above 180, and now it's at 188. So what do we make of this move? Okay, Fitzpatrick notes that when stocks break out a particular trading range, they often establish a new channel right above it, and usually it's the same size as the one that's below. These boxes are boxes of prices. That's a cool word, isn't it? Boxes of prices are known as Darvis boxes because a trader by the name of Nicholas Darvis first came up with the idea. They look like a flight of stairs, okay? And this is pretty cool stuff. Based on this method, Lulu just broke out of the 160 to 180 box. That means its next ceiling resistance should be at 200. See, up 20. However, Fitzpatrick says this is a short-term target, not a long-term one. What else? He likes that Lulu's floor of support is defined by its 50-day moving average. That's the red line. Very positive. Same goes for the fact that it's flying on very high volume. You see the spike in volume right here? That's very important because it's a sure sign that big money keeps flowing into this stock. All right, how about a longer-term view? I want you to take a look at Lululemon's weekly chart, okay? On this one, the longer-term 40-week moving average, okay, here's the blue line, defines Lulu's floor of support. Isn't this pretty consistent, right? I mean, that really does tell you the story. It's good news. Why is it good news? Well, because Fitzpatrick thinks that the slope of the 40-week moving average is just about right. It's not too flat, which would indicate that the stock is stagnating. It's not too steep, which would mean it's having a parabolic move, and easy money has already been made. Parabolic moves, according to Cramer, are always bad moves. Can't go up too fast. This is a Goldilocks slope, so to speak, indicating Lulu's moving higher at a rate that's just right. Now, if we use the same Darvis box methodology on the weekly chart, what does it give us? Well, for the past several months, Lulu's been trading in a range between 110 and 165. That's a $55 range. So if we operate under the assumption that stocks go from one box to another box of the same size, that means Lululemon's new range should run from 165 to 220. And that's why Fitzpatrick thinks it can go to 220 over a longer period of time. What else? Fitzpatrick points out that you can see 7 or 8 very tall volume bars, and they're all green, okay? All right, so this is important. In other words, the stock has been roaring on high volume, which gives us more evidence that major institutions are putting their money to work in Lululemon. That's why it thinks it's not too late to buy the stock. As long as the stock stays above its 40-week moving average, of which it's well above right now, Fitzpatrick remains a believer. You can see all the big moves are up on big volume. All right, now how about one that really people have given up on except for me, and now they're starting, the Johnny-come-latelys are joining now. I'm talking about Under Armour. Yes, this one has a very different trajectory. Witness the action in Under Armour's weekly chart, okay? Here's a stock that spent years getting hammered. I mean, oh man. It's now down 50% from its highs in 2015. But Under Armour has finally started showing signs of life as it pops out of what's known as a volatility squeeze. All right. So where does Fitzpatrick think it's headed? Okay, before the breakout, Under Armour was trading between $16.50 and $25. Okay, you can see this, boom, boom, boom. And that gives us an $8.50 range. This channel first started forming early last year when the stock first broke out above its 40-week moving average. For Fitzpatrick, that means it is an extremely durable and reliable base that can serve as a springboard for much higher prices. Squeeze, boom, okay? If we use the same measured methodology that we used for Lululemon, that means this stock is now trading between 25 and 33.50. Given that it spent months coiled like a spring right below its old ceiling of resistance, Fitzpatrick thinks the stock can cover that ground pretty darn quickly. And even at 33.50, up 23% from these levels, Under Armour would still be 39% below its all-time highs. So that's not a crazy target at all. I agree. So how do we get here? Take a look at Under Armour's daily chart. Fitzpatrick says that the stock's recent run is all about a volatility squeeze. Remember, I mentioned that. And you measure volatility with these two black lines that are known as Bollinger Bands, okay? John Bollinger, unbelievable technician, okay? When these bands get tight, it often leads to a big move in price because volatility is cyclical. You go from periods of low volatility to periods of high volatility, and that's what's happening right now with Under Armour. At the same time, there's the moving average convergence divergence, or MACD indicator, right down here, okay? And that powerful momentum gauge helps technicians detect changes in a stock's trajectory before, not coincident, but before they happen. And it continues to tell a bullish story. Fitzpatrick also notes that Under Armour is now getting support not from its longer-term 50-day moving average, but from its shorter-term 20-day moving average, the blue line, okay? I mean, you can see that. It's getting support from there, which the stock rebounded off of last month. That's another sign of upward momentum. Finally, let's zoom in with a short-term version of the daily chart going back to April, okay? Wow, a lot of stuff here. Fitzpatrick has one problem with Under Armour based on this action. While the stock has exploded higher over the past couple of weeks, the volume has been a bit light. Remember, volume is like a polygraph for technicians. High volume means a move is telling the truth. Light volume means it might be lying. So when a stock rallies, you want it to rally on a rising volume. Under Armour did that at the very beginning of the month when the stock rebounded off that 50-day moving average that I showed you earlier, okay? Since then, though, while the rally has continued, the volume has dropped off, as we see. That's not fatal to the story, but it definitely makes Fitzpatrick more cautious. Right now, he'd be happy just to see Under Armour regroup at current levels and give its moving averages time to play catch-up. Still, he thinks it's worth buying on any kind of pullback, and boy, do I ever agree with him. Here's the bottom line. While Lululemon and Under Armour have pole vaulted higher in recent weeks, the chart is interpreted by Dan Fitzpatrick suggests that both stocks could have more room to run. He thinks you aren't too late, and you know what? I agree with him. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.